Hello and welcome. My name is Megan Zweig. I am the new Director of Research here at Rock Health. Really excited to be chatting with you all today about our mid-year funding report. It was quite a half. So as many of you probably know, we kind of report out quarterly funding trends. And last quarter, you may have seen our blog post, and we said, business as usual, really nothing out of the ordinary, still strong funding, but very much in line with what we had seen in prior quarters. And then we saw a huge upswing in the latter half of this half. So my goal for you for today is really to walk you through that data, show you the numbers, provide insight beyond the numbers, and give you a sense of what we're hearing from entrepreneurs, investors, as well as take your questions. And on the question front, I wanted to let you know how to use the live chat function. So you will need to create a YouTube channel if you don't have one already. It's pretty easy. I did it the other day. So to do that, you just open the drop-down navigation bar, which is in the upper left-hand corner of your screen near that YouTube logo. If you click on that and then you click on My Channel, you'll be prompted to create a channel using your existing Gmail account. You can use your personal account, your business account, whatever you prefer, but that will enable you to type in that chat box that you should see to the right of your screen. One other housekeeping item, I know that kind of the clarity of the webinar image will depend on your settings. So if you want a crisper image, you can click on settings. That's in the bottom right hand of the image box. Click on quality, and then you can choose to have more of an HD image. So again, the image will be and text will be a bit crisper. I'll be checking on questions throughout. So again, type those into the live chat function, and I'll reserve some time at the end of the webinar for that discussion. And if I don't get to every question, do not fret. I will absolutely follow up with you individually just to make sure that we're responding to all of your comments and questions. So before I dive into the numbers, I do want to acknowledge that this report was truly a team effort. Really fun partnering with Hallie Tecco, founder of Rock Health. She provided her guidance and insight on the industry. And really the whole team pitched in to make sure that we were tracking down every single digital health deal this half. So just want to express my gratitude to all of them. And thank you to you. I mean, to our subscribers, to our corporate partners. We really couldn't do this work without you, and really appreciate your ongoing support. I don't expect you to read this page, but if you haven't seen kind of the full report yet, we can definitely send that in follow-up. But I'm going to click ahead and kind of get into our table of contents. So this is a bit of an overview of what we're going to talk about today. So first, just diving into the dollars and deals. What were the funding totals? Talk a bit about the mega deals that we saw, and kind of then get into who are the investors in this space. A lot of new investors, which is exciting. So we're going to talk a bit about that. Kind of where are these companies located across the US? CEO demographics. So talk a bit about kind of the gender gap that we continue to see in terms of digital health startup founders, and then we'll get into exits in public markets. So talk a bit about M&A, IPOs, how the digital health public index is doing, and then we can wrap up with some conclusions and questions. So I do want to give a brief explanation of what we are tracking here at Rock Health. So we have a funding database, which hopefully all of you know at this point. You all have access to it through your Gumroad accounts. It tracks every single digital health deal over $2 million for US-based companies. So every quarter, again, we are putting out a report highlighting the major trends in funding, in exit activity, and that's really to help investors, entrepreneurs, and our enterprise partners just have a deeper understanding of what's going on in this space, using funding and exits as the lens through which to kind of analyze activity and analyze what's going on with digital health and where we think it's headed. So let's get into the big story, which is the funding totals. So again, we saw the most funding we've actually ever seen in a month, in a quarter, and ultimately in a half. So May was the biggest month we've ever had in digital health funding, and that really propelled the entire half to kind of land at $3.5 billion. So thus far, again, through June 30th in 2017, digital health companies have raised $3.5 billion, which is tracking well above what we've seen in the past. And you can see that as illustrated by that green line. So in the past, at the half year mark, closer to the $2.5 billion range. And so I think what's interesting to me is even if we return to kind of the normal pace of funding that we've seen in prior years, this year would still be the biggest year in digital health funding that we've ever had. So that's pretty exciting. That number, that kind of $3.5 billion, really driven by 188 deals. And these deals were all to unique companies. So you might be thinking to yourself, did we just have this really big half because of a few really large deals? And I think this slide sheds some light on that question. So let me just orient you to the graphic. Kind of those light green bars are showing you kind of total funding, total amount raised. That the dark green bar is showing the number of companies that received that funding. And then across the bottom, those circles showing the average deal size across the different years. So really a record-breaking half on a lot of fronts. So record-breaking in terms of the total number of funding, record-breaking in terms of the number of companies funded, and also record-breaking in terms of average deal size. And yes, there were a lot of mega deals. We tracked seven deals over $100 million, and we'll get into those. So those mega deals definitely accounting for that funding bump. But I think there's also another story here, which is that we've had the most companies funded in a half. So we're seeing more bigger deals, which in my mind is a sign that there's kind of broad investor excitement in this space. One thing to note, we do include this slide in all of our reports, and the numbers may not entirely match up. So if you looked at the end of our 2016 report, those numbers might be different than what we're reporting right now for 2016. The reason for that is we are constantly digging through SEC filings, SEC amendments. There's new publicly available information that comes out. And so we want to make sure that all of the data in our database is as up to date as possible. And so we do make some of those revisions. And so that's why some of those might be slightly different than what you saw at the end of 2016. We just get questions on that, so wanted to proactively address it. Now, again, before I kind of dive into these numbers, I just wanted to talk about the fact that we were surprised. I mean, we were surprised by the funding upswing this half. Generally, entrepreneurs like certainty in the industry. With certainty, they know which opportunities to go after. They know where the market is headed. And so they can kind of craft strategies, innovation, products to go after those certain opportunities. These past few months in healthcare, you might have noticed, have been anything but certain. And we really didn't know until this week whether or not Obamacare was going to be repealed and replaced. So it begs the question, why was there this uptick in funding? And I think there are a few potential answers. I don't think these are exhaustive. I don't think these are the only right ones. But kind of my hypotheses are really threefold. One is, funds have already been raised. If you raise a fund, you're going to deploy it over a certain period of time. So you're not going to see perfect alignment between policy and kind of venture capital deployment because they're going to be investing those dollars that they've already raised. Second is we've just seen more money. I'll get into this more later, but there are a lot of tourist investors making their first investment in digital health. So there's just more money in the system to be deployed. And then the third reason is I would argue that there actually kind of may not have been as much fluctuation, hesitance in funding digital health because there are some trends in healthcare that will continue and we're going to continue regardless of the outcome of the policy debate. One of those is value-based care. So the discussion in Washington really revolved around coverage reform, especially around the Medicaid population. And kind of how people were going to get insurance through the public markets, who would be covered, et cetera. Apart from that, there does seem to be bipartisan support to continue moving towards value-based care. And so CMS has been pushing this along through their payment reform programs. When you think about their bundled payment programs, accountable care organizations, MACRA, kind of all of those programs are seeking to pay providers, both health systems and clinicians, based on the value of care as opposed to the volume of care. So safe bet that companies are going to continue to innovate to help providers provide that higher quality, lower cost care. We actually talked to Christine Lemke, the president of Evidation. The way that she put it was, funding remains strong, and irrespective of government policy, companies and people are still aggressively seeking ways to drive efficiency and improve outcomes. So this type of value seeking is the driver of market innovation. And then the second kind of big trend that I think has taken hold is consumerism. I mean, under Obamacare, we saw deductibles go up, more consumer cost exposure. This has the impact of causing patients to behave more like consumers. They're shopping for care. And that has a lot of implications for digital health. I mean, to be a consumer, you need transparency. You need insight into the cost and quality of what you're buying. We see a lot of companies filling that space. There's a need for more affordable healthcare solutions and experiences. And there's a greater need to respond to what patients want. If they're shopping around, they're going to be looking for convenience, experience, affordability, and they're going to be looking for things that historically the healthcare system hasn't necessarily executed on very well. And so you'll see companies come in and try to fill that consumer niche. So again, my take is kind of those larger forces of the shift to value-based care, consumerism, they are cemented in the healthcare industry sufficiently to continue to drive innovation there. It'll be really interesting to see in the back half where there's more certainty that kind of Obamacare is here to stay. At least that's what it looks like this week. If that certainty will, if we'll see kind of any difference in funding because of that. So thank you for bearing with me on that kind of explanation of why we were surprised, but why we did see those upswings. And I want to talk a bit about those mega deals. So again, we saw 7 mega deals, which we define as over $100 million, each including, and of those 7, we did see the 2 largest digital health deals that we've ever seen. So Outcome Health, at the top of the list, they closed their first round of funding at $500 million. It was led by growth investors, Goldman Sachs, Capital G, among others. They actually hadn't taken funding until this round. And then Peloton Interactive, they closed their Series E. This is the second largest deal we've ever seen at $325 million. We do include Peloton in our definition of digital health. It's a connected piece of gym equipment. In this case, it's a stationary bike you can ride in your home, but you're looking at a connected screen. So you're connected to a community, a class, and some kind of tracking tools. So a few comments I'll make here. One is, as the digital health market matures and companies begin to show real revenue potential, we are seeing more growth stage private equity investors leading these large pre-IPO rounds. Second thing is, these aren't overnight successes. So we talk a lot in healthcare about how it's different, how there are longer sales cycles, more regulatory hoops to jump through. There's a big burden of proof. So it's worth noting that these companies weren't founded a few years ago and then landed these huge mega deals. Outcome Health was founded in 2006. ShareCare was 2009. Patient Point, I think, may have been in the late 80s. So, long time, over a decade to build their businesses, their client base, their revenue, kind of to get to the point where they're able to secure these massive deals. Last thing to note, which is kind of interesting, none of these companies are based in Silicon Valley. They're really spread across the US, and we'll talk a bit more about that later. So 7 mega deals this half, and the next slide will really put that into perspective for you. So the last time we had 7 mega deals was in 2014, and that was the entire year. So we've already matched that year. So, I think you can put your bets on that we'll probably beat that record in 2017. If you look at these companies, nearly a quarter of them have gone on to raise money on the public markets. So that includes Castlight, Evolent, Nant Health, Invitae, and then one of them, Jawbone, as we heard recently, will be shutting down. So for every company, we do assign a category based on what they do. And then we kind of sum up the funding to figure out which of those categories kind of received the most funding. So this year, the mega deals really influenced those top funded categories. So for instance, Outcome Health with its $500 deal, classified as consumer health information, they kind of produce patient education and content that's on screens and iPads in physician offices and in hospitals. Again, we classified it as consumer health information. And so that category came out at the top of our category list. Digital gym equipment has actually never been on our top list of categories before. There's actually only a handful of kind of deals that have happened historically in this category, but because of Peloton, launched to the top of our list. So these top 6 categories account for 63% of all digital health funding. And only one of them, so analytics, big data, which you see in the bottom middle, was in the top 6 categories from last year. Now, as I said, those mega deals definitely did drive these categories. And so we also wanted to see if you strip those out, kind of do these top categories change. So that's the analysis that you see on the next slide, slide 10. So just to orient you to the graphic, in 2016, this lists the top 6 categories on the left-hand side of the slide. In the middle, we have our top categories from this half. And then on the right, we have the top categories from this half, but without those mega deals over $100 million. And what you can see, so 3 stay in the top: healthcare, consumer engagement, digital therapies, analytics, big data. And so the top categories with and without the mega deals, I think they do show diverse investor interest. So strong interest in both consumer-centric companies working on engagement, wearables, personal health tools and tracking, but definitely also seeing interest investment in kind of more clinically, the hard kind of clinical innovation through digital therapies and diagnostics. So next, I wanted to share a bit of information about the types of deals we saw in terms of stage. Not a big surprise here, tracking similar to what we've seen in the past, where most of the deals are still seed and Series A. Series B deals decreased a little bit year over year. They accounted for 15% of all deals. Series C and kind of D or greater deals moderately increased. So no huge surprises there. And I wanted to talk next about just who's doing this investing. We saw 331 distinct investors complete deals, and 138 of those, so that's 42% of total investors, were actually new to the digital health space. So most investors are repeat investors, and I think that indicates, the continued maturation of the space. You see investors kind of moving beyond just dabbling and instead kind of getting into double down mode. Venture firms have been the most active. So 10 firms that are listed here on the left on slide 12 have made 3 or more investments. And the most active venture investors are largely on pace with prior years. So for instance, Khosla Ventures, 406 Ventures, they each had 3 deals each, which is pretty on pace with the 6 that they each respectively made last year in 2016. One notable exception, Anderson Horowitz, they haven't closed any deals yet this year, but they did close 6 last year and have made 21 over the past 6 years. So that was kind of one notable exception. Among the corporate investors, so on the right-hand side of the slide, Mayo Clinic has already made 4 investments, which is interesting. In the past, they've only made up to 2 deals in a year. And we didn't see many deals from UPMC, even though they were a pretty active investor last year. So we talked to Sean Duffy, who's the CEO from Omada, which is one of Rock Health's portfolio companies. He commented on all the investors in the space, and he told us, more interesting than the headline number is the types of investors who are involved in digital health fundraising. So in addition to some of the leading venture capital firms in healthcare and technology, we're seeing venture arms of health plans, health systems, even pharma companies put significant amounts of money into the right digital health solutions. So digital health here to stay, the industry is maturing, and we can anticipate a more sophisticated buying market that will demand effective evidence-based solutions that can integrate into medical plan design and clinical workflows. We also asked some investors kind of what they thought of these so-called tourist investors in digital health. If you subscribe to the Rock Health podcast and listen to kind of the episode that came out earlier this week, you would have heard Steve Krause from Bessemer and kind of Liz Rocket from Kaiser Permanente Ventures talk about this a bit. Steve kind of talked about how there's been just a massive explosion in venture funding overall. So that's naturally going to trickle down to healthcare. There's just a lot of cash out there. I think the worry is that those new investors may come with expectations of disruption and hyperscaling innovation, which they may have seen in other industries. So I think there's the worry that kind of those expectations may not necessarily line up with the reality in digital health. So again, interesting to track. Will we continue to see those kind of new investors? Will we see them becoming repeat investors? And kind of will that trend continue? So something to track. So next up, wanted to just kind of give a snapshot of the US and where all the digital health deals are happening. We saw companies in 25 states receive deals. No surprise here. I mean, California is still leading, accounting for over a third of total dollars invested, particularly in the Silicon Valley area. For the first time, New York and Illinois joined California in the top tier of funding. So that means that they had companies who collectively raised over $500 million, while in Florida, Georgia, and Ohio, they actually joined Massachusetts in that second tier of funding, so raising $100 to $500 million. And we are seeing some pretty big deals outside the usual hubs. So just to rattle off some cities, Cincinnati, Bethesda, Miami, Milwaukee, Nashville, St. Cloud, they all had companies who received rounds over $20 million. So it's pretty interesting to see kind of digital health start to take its hold outside of Silicon Valley and across the US. So one data point that didn't take off this half, unfortunately, was the percentage of female CEOs of companies that were funded. So those that were funded, we listed them all on the left and kind of put their pictures. So there were 21 of them. But as you can see on the right, only 11% of funded companies had a woman CEO, which is pretty in line with what we've seen in the past. So unfortunately, you can see kind of not a ton of improvement in this number over the 5 years that we've been tracking it. We will definitely be digging into this more. So we're going to be putting out a State of Women in Healthcare report later this year. So if this is a topic that you're passionate about, definitely let us know. I think we'd love to have you take our survey and potentially kind of do an interview on the topic. We're also hosting an event in our offices with C-Sweetener on August 14th. C-Sweetener is an organization that connects female healthcare leaders with mentors, both male and female mentors. So we're going to be talking about ways to improve gender diversity in leadership. So again, if that's something you're interested in attending, if you're in the San Francisco area, definitely ping me after the webinar. We'd be happy to share the details with you. So that wraps up our first kind of section of the report on funding numbers. And absolutely, with this influx of dollars, investors are going to expect to see some returns. So let's dive into the exit market. Exit activity did not have the banner half that that fundraising did. We tracked 58 digital health mergers and acquisitions in H1, which is behind the 146 deals that were closed last year. And so that means at the half mark, there were 87 M&A deals. So this year, we're kind of about a third behind the number of M&A deals that were closed at this time last year. We listed some of the kind of disclosed deals. Of note, McKesson bought Cover My Meds for $1.1 billion. Teladoc purchased Boston's Best Doctors for $440 million. Castlight picked up Jif for $135 million. Also, Apple made an undisclosed acquisition of Bedit, which is a direct-to-consumer play for sleep monitoring. That's pretty notable because I think some investors, and this also kind of was discussed at length on the Rock Health podcast, but they've mentioned that with Titan companies coming into healthcare, so Apple, Microsoft, Amazon, we could potentially see an upswing in exit activity if they become kind of more interested in acquiring in the digital health space. So when we look at kind of who was doing the acquiring and what types of companies they were acquiring, kind of that's what we've laid out on this slide. So when we look at who's making these acquisitions, if you look to the left, it's largely digital health companies that are acquiring other digital health companies. This is similar to what we've seen in the past. And then if you look to the right, this shows the type of companies that we saw largely acquired. So you see they generally do represent kind of the traditional enterprise plays. So payer administration, enterprise wellness, life sciences. Enterprise wellness is pretty interesting. Definitely picking up steam with 5 M&A deals completed this year, whereas there were only 6 across 2015 and 2016 altogether. And I think we've just been getting more questions about it at Rock Health. I think there's really a desire for kind of fewer point solutions and instead kind of an enterprise platform to kind of manage and aggregate all of those point solutions into kind of a single platform. So on the IPO side, so now we're on slide 17, we did not see any activity yet. So as you can see, apart from 2011, we've had at least one digital health IPO every year. No IPOs so far may not be super surprising. I mean, stepping back, digital health is still in its early stages. There haven't been that many IPOs overall, but we decided that we wanted to do an analysis to figure out, should we be expecting any IPOs soon? Should we be on the lookout? So what we did is we looked at all the digital health companies that have gone public, and it's the 18 companies listed here. And we found a couple of interesting takeaways that might inform kind of what IPOs we should be looking out for. So the first thing is that digital health companies take an average of 10 years from founding to IPO, and there are exceptions. So Evolent Health managed to cut this time to just 4 years. So they're not all clustering around that 10-year mark. There is kind of wide variation, and you can see that in the third column here, years to IPO, but on average, taking 10 years from being founded to going public. The second thing is, before going public, these companies raised an average of $136 million from venture capital before going public. Again, wide range here. So Viva Systems went public after they raised only $7 million, whereas Nant Health raised over $750 million, but again, the average being $136. So we essentially asked ourselves, how many companies have we seen in the digital health space who are not yet public, but have hit this threshold of $136 million in venture dollars raised? And so that's what you see on the next slide. There's actually a fair amount of companies that have hit that $136 million threshold. And 20 of those companies have not gone public yet. So those are the kind of 2 boxes that you see to the left and in the middle. The ones to the right have IPO'd. 7 of these companies are unicorns, meaning that they've been valued at over $1 billion. That number actually is now down to 6. We did put that asterisk next to Jawbone, just given their recent news of going out of business. So we cannot know with certainty that any one of these companies or any other digital health company will IPO in the next few months, but it does tell us that we should be watching out, because this is a pipeline of highly capitalized companies that may be marching towards some type of event. And things are looking up kind of on the public markets overall. So the digital health public company index is up 30% year to date. That's compared to the S&P 500, which is up 8% year to date. The vast majority of stocks on this index closed the quarter with positive year-to-date returns indicated by the green shading. The biggest market winners at the top of this list, Teladoc up 110% year-to-date, Care.com up 80%, and Evolent Health up 70%. 5 companies in the red are trading below their 2017 opening stock price. Fitbit is included there. They're calling 2017 a transition year as they explore more medical use cases, and they actually hit a 52-week low this quarter. So I know I raced through some of that, but really a record-breaking half. I think we're super excited to see what happens the rest of the year, especially given some of the certainty around where health policy is headed. Things could always get shaken up, so we'll definitely keep our pulse on that as well. But definitely feel free to queue up any questions. So if you have questions about these findings, about the data, I guess you have a couple of choices. One is to use that live chat function. So my colleague Danielle is actually monitoring that right now. So feel free to enter in your question there, and we can respond to that. And then the other option is I'm actually going to flip ahead just so you have our email. So research@rockhealth.org. Feel free to email us anytime. My personal email is megan@rockhealth.org. So feel free to use that as well. That's MEGAN@rockhealth.org. I'm always pumped to connect with all of you and just hear your feedback and questions as we try to kind of make sense together of this space. So I'm going to go ahead and check and see if we've received any questions. It doesn't look like anything is in the queue yet, but kind of we'll hold for a couple of moments just to see if anything comes in. In the meantime, I wanted to just remind you kind of our methodology and how we do this work. Again, kind of digital health being the intersection of healthcare and technology. So tracking any digital health company that's raising more than $2 million in the US. Some companies are on the fence, and we do have internal kind of guidelines around what we include and what we don't. So kind of service predominant companies aren't included. So healthcare providers like One Medical, insurance companies like Oscar, we do not include those companies in our database. Molecular diagnostic companies, so Guardant Health, those are excluded as well, in addition to technology companies that aren't healthcare. So something like a Zenefits wouldn't be included because it isn't solely a healthcare focus. And if you ever have any questions about that methodology, definitely let us know. And we are publishing our revisions. So as I said, we're continuously monitoring publicly available data to make sure that the funding database is as accurate as it possibly can be. And so here you can just see all of the SEC amendments that we found this half, which led to revisions of some funding amounts. So again, just want to reiterate, we really appreciate your support as subscribers and partners. Again, if you have questions, feel free to reach out to us. We want to know how we can make these webinars, this work better and more helpful for you. So we did just get a question in. Do we have any insights as to what traits investors find most attractive or unattractive? It's a great question. It's actually one, so I don't want to totally punt this question, but it's actually one that came up on our podcast conversation that we had the other day with Liz Rocket from Kaiser Permanente Ventures, as well as Steve Kraus from Bessemer. And I think there was kind of some, actually a lot of consensus around what they're looking for, what we look for at Rock Health as an investor. I mean, one, of course, is you can't get away from just assessing the team. I mean, are these committed, smart folks who understand the healthcare industry and understand kind of the challenges. Of course, you need to have a plan for the longer sales cycles, for are you going to get FDA approval? How are you going to navigate the regulatory environment? So really just being hyper aware of what some of those obstacles are, and having a game plan for those, in addition to just having, as entrepreneurs, kind of proven track records, or else just a lot of potential and commitment. Two is, depending on kind of the clinical validation that's necessary, that's definitely something that they're looking for. Another one that Liz brought up, which I thought was a good point, is just kind of ability to scale. She mentioned that in healthcare, kind of across different types of stakeholders, pharma, insurance companies, health systems, there are a few early adopters. Like, each of those sectors have some innovative early adopters that are going to get on board with these technologies. But after those early innovators, it can be really tough to secure more clients, to scale that innovation across the industry. And so I think she's looking for evidence that it isn't just getting the early innovators to adopt, but can this truly be integrated into the current kind of clinical workflow that providers are working in, or kind of the current value chain of those other enterprise stakeholders like payers and pharma. So that's kind of definitely something that they're looking for, is traction, scalability, and also, is this providing sufficient value that an organization is willing to potentially kind of change their workflow, retrain employees in order to use it? Like, are they willing to go through that upfront investment and change in order to get this in place and adopt it? And to go through all of that, it's got to provide a lot of upfront value. So those are a few of the attributes that come to mind that came out of kind of that conversation that I just had with them. Great question. Okay, well, I'm looking forward to giving you all some extra time back in your day, but thank you again so much for joining us. I will give us a plug one more time. If you have more questions, comments, definitely feel free to reach out to us. And again, if you are interested in that event kind of in our office around promoting women leaders in healthcare, that's going to be happening in August. We're super excited about it. Definitely reach out and we can give you the details. The other promotion I will make, and then I promise to let you go, is that we're so excited for the Rock Health Summit, which is coming up in October. The early bird ticket pricing ends tomorrow. So if you haven't gotten your tickets yet, definitely check that out, because prices will be going up tomorrow. Okay, well, enjoy the rest of your week and your weekend, and have a good day. Okay.